Okay, hello everybody. Welcome to Korean Atlanta Mentorship here with another Velocity Banking review. And I have a confession. I'm just kind of bored talking about this, especially since for the last, I don't know, 100 or so videos, all I did was talk about how I paid off a mortgage under 3 years, actually 2 years and 9 months, as you can see in the picture. It is true. I'm flexing a little bit, but I actually did pay off a mortgage in 2 years and 9 months. And also, I have over $739,000 in lines of credit and credit cards. Yep. Just had to get out of that flex before we start that velocity banking review. And, telling people that you're so bored of talking about paying off a mortgage in 2 years and 9 months, that's the ultimate flex. But that's what we're going to do today, review velocity banking. What are we doing? Paying off debt. Okay. So, velocity banking, what is it? Basically, a debt payoff strategy where you throw all of your money into debt using something called a line of credit. So, the way I like to present it is in a way that doesn't actually use the words velocity banking, right? So, what I like to show is a clear case of where you would want to use it, and you cannot think of, how to solve the problem at hand. And I've actually had people send me their spreadsheets, their financials, and people saying, "Oh my goodness, I can't go to sleep because I have $1,000 left over." There was one case that I thought was amazing where the person only had $4 left over in 22 debts, okay? That if you know how to solve that problem, then you're at the PhD level of velocity banking. So the way that I present is, hey, if you have all this income and all this expenses in debt, because take a look here, 10 credit cards, an auto loan mortgage, and on top of that, your general personal expenses, and you only have one penny left over the month, can you get through this situation without making more money? Right. And everybody will say, oh, you need to make more money. So the whole point of velocity banking is showing that if we redirect the flow of money and not save it, right, we can increase something called our cash flow. Right. So what we do is we copy and paste the income, the expenses, all right, and then we don't save money. Okay, very important that we don't save money throughout the process of when we pay off debt. It's a debt payoff strategy. So here's a crazy thing: like if you have a penny of savings, that's actually seen as more responsible than not saving money, right? And if you take a look here, I just kind of talk about. I do what I talk about, right? So if money comes in, $0 and then it just goes right out. So basically, how do we treat our checking or savings, right? And maybe I should put like checking or savings here so we know that this includes both. Is that where in the flow of our money does our checking savings go? So, with the average American style of banking, our checking account is seen as the final destination of our money, and then with velocity banking, it's just kind of seen as the middleman. We just use it to kind of send and receive money. We don't use it to store money. Right. When we store money, we're essentially losing out on either higher interest debts that we have. Right. That's one reason why we'd be missing out, or just inflation in general. So if we're not investing, and that's kind of more at a higher level once you have most of your personal debt paid off, but you want to invest that money at a certain time when you're ready, right? So that's kind of the way we think about the checking savings, that it's not a place to store our money, kind of like how Dave Ramsey would tell you to do, that you at least need to save $1,000, right? So we have all this debt, and we're going to use something called a line of credit. And what is a line of credit? It's basically a financial tool where you could borrow money, pay back, and then use it over and over again. So this is my home equity line of credit, $373,500. Basically, I could go to the bank's website, click a button, and then they'll dump up to that amount at an 8.5% interest rate, right? Pretty much no questions asked. I mean, it's so easy. I just go to bank's website and click this button, and then it's there, right? I just say line of credit to checking account. See how easy that is? All right, so that's basically what a line of credit, I is for, right? So basically, we're gonna use it as a way to increase our cash flow, and, be able to pay off all our debt, okay? So we have, or in my personal case, I actually have over $739,000 in lines of credit. That includes credit cards, right? Personal lines of credit, home equity lines of credit, and I think soon I'll get a business line of credit soon, right? Okay, so I got all of them. Okay, I'm sorry. I think I caught something, but I feel pretty good today, actually, even though I cough a little bit here and there. All right, so here's the secret to getting all of these credit lines is that you have to understand what the bank wants, and the bank doesn't want to lend to people who need money because TLDR, people who need money don't pay you back. Right? People who need money don't pay you back. So how did I get all these lines of credit? Well, basically, I just went to a bank when I didn't need money, and then eventually throughout the years, it didn't take me that long, maybe like 2, 3 years. I got over $739,000 in lines of credit. And if you take a look here, this makes me a top 0.01% according to ChatGPT, right? And so what we're gonna do is assume we have a huge line of credit, but even though we're here, we have a penny left over. The bank is not going to give us a free and clear line of credit because banks don't lend money to people who need it, right? So we have to think about when we're likely to get credit. Now, why do we do examples of a free and clear line of credit? Because it's like saying, hey, if you crash your car without car insurance and then someone gave you car insurance, that would be a lifesaver, right? But not going to happen. Which is why you need to get the car insurance before you start to drive. Same thing with a line of credit. You need to get it before you get, before you get into debt and before you need money. Banks don't lend money to people who need it. Long story short, but it makes it easy to demonstrate the benefits of doing things right, right? And we actually have real life case scenarios in the paid membership where people have lines of credit and they misuse it because it's just like another maxed out credit card. Okay. All right. So let's go ahead and do this, and we're going to use the cash flow index again, right? So basically, cash flow index is a ranking system of debt. You get the debt amount divided by the payment, and then you just kind of do this, and it'll create like a ranking order. And the lower the number, the more bang you get for your buck for paying off debt. So this high number means if I pay off this debt, I get very little bang for my buck. Like I literally have to pay someone $220,000 in order to get $927 back in my cash flow, right? Whereas I could just pay the 35 and get even more than that, right? Then this $927 back in my cash flow. So it's all about bang for your buck. So what we're gonna do is take these low numbers, move it into a line of credit. Okay, and how much was this? This is 5, 8, 15, 27, 37, 10, 35, 12, 15, and I'm gonna go ahead and sum it up. And then that's $164,000 in lines of credit. So I'm just going to do 164,000. And then guess what happens once we just transfer some of the debt into the line of credit? Oh my goodness, these go to zero, right? It's basically a balance transfer. And then, whoa, how do we go from a penny here to 5,000 whatever and change, right? I feel like if I show this to people, like they should be like really like mind blown that this is possible without making more money. But man, every time I show this to people, like people have this poker face, they don't look like they're too cool for school. I'm pretty sure if you're watching online, you're not like that because you're just watching in private and you're thinking, what the F? How did this turn to from a penny to over $5,000 and we didn't make more money, right? But like I said before, if you just kind of see this from a problem solving manner of like, hey, if you just had a penny left, how do you get out of this hole without making more money? Then you'll see the clear benefit of velocity banking. Okay, you'll see the clear benefit probably. Okay, and then the final step is you put your entire paycheck into the line, check your expenses out, and then you're going to rinse and repeat over and over again. So after every single month, the balance of the line will go down by your cash flow number with some interest added for using that line of credit. So I'm going to do this. I'm going to do this, and then minus 5110.84, and then I'm going to take the average daily balance, right? Average daily balance, multiply by the interest rate, and then divide by 12. And then I'm going to copy and paste, right? Copy and paste, and then bam, 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 bam. And then you see that in month 37, all your credit cards are paid off, right? So, wow, that was really easy. 37 months, 164K of debt, right? 164K of debt. And then now we just do the auto and the mortgage. And then, I'm pretty sleepy right now because it's like 11:16. And, me flexing again because I paid off my mortgage under 3 years, just like in the title. I'm just gonna act like I'm bored so I can flex. It's so boring. Well, it kinda is because I've been talking about the same thing for the last, I don't know, feels like say 1,000 videos, but you know the saying, the Bruce Lee saying, where, "You fear the man who does 1 kick 10,000 times, not the man who does 10,000 kicks once." We live in a society where most people do 10,000 kicks one time. It's kinda strange how that is. Like, people like, you ask the average person what it is that they're doing, and they're, like, busy doing 100 things, and then you ask them, like, "Did it lead to anything fruitful?" They get very defensive because they know that whatever they did didn't really lead to anything fruitful, but it's okay. Alright, I'm not here to call anybody out. Alright, so let's go ahead and do this. So 37 months, so I just gotta put, 37, 37, right? And then this is, a calculator that shows you the current balance of loans based on the month, and then we just use the same cash flow index idea right here. And then, I'm gonna just do this, and then this is gonna be plus 6869.96. So now the auto loan has been paid off with the extra $309 in cash flow. And so now what we do is we just kind of replace the cash flow with the extra $300, okay? And then this is going to be 5420.1. Oh, excuse me. Caught little something. I don't know if it's yesterday or 2 days ago, but I have been sneezing. Okay, so we see that in 38 months we paid off the auto loan, right? So now we just do 38 months, 164 plus 17, and then this will be 181K. And then now we tackle on the mortgage at 38 months, and then this is going to be 0. And then now we have two options when it comes to paying off the mortgage. We can just put the extra payments from here, right? The 5,000 directly to the mortgage, or we could just use a line of credit. Either one is fine. I would prefer using a line of credit in certain instances because it just makes it easier because all I can do is just dump my money into one place. Whereas if I don't use a line of credit, I'm going to dump all of it here into the mortgage, and then I'm probably going to start using a credit line here, and then start segregating my income, which is where we got into this hole in the first place. I'm not going to go too deep into that, but I'm just saying that a lot of people freak out because sometimes you might see people say, "I even use a 30% credit card to pay off a line of credit." Well, okay, let's go ahead and do that. So 2049, oopsie, 204,970.05. I think that's the current balance of the mortgage. And then what we're going to do is put in the income, the expenses. So it's 8447.63. And then this is going to be the living expenses, which is everything except for the loan we're trying to pay off, which is 2,100. And then I just want to show you that even if we use a 30% credit card, look at this, paid us off under 3 years. Okay. So you could just like swipe a credit card. And the main reason why I might even use a credit card is that, hey, if it's going to be mostly the same, meaning I might get like cash back rewards that will, sorry, greatly reduce the interest here. And also, if the credit card company sees I'm making like $9,000 swipes, what's the likelihood they're going to increase my credit limit? Very high. In fact, this happened to me recently where I had a $10,000 credit card where I magically woke up and then the credit limit was 17,500, right? So if you want to kind of go that route, you can. But the thing that I'm trying to show is that, hey, even if there's an interest rate difference, right? Yeah, the higher the interest rate, obviously, the more it affects it. But higher interest rates is something that you don't really have to fear because if I go from 30 to 8, it's only about $4,000 difference. Right. And then you can use some sort of arbitrage to kind of make up that $4,000 if you really wanted to, like cashback rewards and stuff. Okay. All right. Well, that's it for today, folks. 2.9 years. I mean, wasn't that really boring? Less than 3 years. So I'm just going to do 0. And then I'll be 38 divided by 12 plus 2.9. All right. So 6.707 years. And then we're completely debt free. And, first world problems, right? First world rich people problems where I just kind of brag that, gosh, it's so boring paying off a mortgage under 3 years, right? Paying off a mortgage under 3 years is so boring. Yep. Yep. All right. Well, that's it for today, folks. This is Greenland to Mentorship. Have a great day, and I'll see you on the next video.